Hey, what's up, everybody? David Yang here again with Home Sellers. I want to thank you all for tuning in to another episode of Real Talk, where I talk about real estate. So in this week's episode, we are going to be talking about what a hard money loan is. Now, before we get started, if you could do me a big favor by smashing that thumbs up button below, hopefully the information in this video can help someone else out as well. Okay, so what is a hard money loan? Generally, what a hard money loan is, it's a private loan that real estate investors would use to purchase properties and fix them up, okay? So sometimes you'll see a lot of rehabbers use these types of loans. Now, how come you can't just go to a bank and get a regular loan and do it? Because banks usually aren't in the business of flipping houses, okay? So that's where hard money loans come in. Now, understand that hard money loans are going to be a little bit more riskier to the lenders, so they are going to have a higher interest rate. They are going to have shorter loan terms, okay? Generally, the loan terms can range anywhere from 9 months to 2 years, depending on the lender. Every lender is different, okay? So if you're thinking about getting a hard money loan, talk to the lender to see what their terms are, okay? Now, going back to interest rates can range anywhere from 8 to 15% interest, okay? And the amount that you can borrow depends on the ARV, or the after repair value, what it's worth after it's all fixed up. Generally, the lenders will lend a certain percentage of that. So say, for example, if they're willing to lend you 70% of the ARV, then for easy math, if the home is worth $100,000 after it's all fixed up, they're willing to lend you up to $70,000, okay? Now, that's kind of a broad general overview of it, but sometimes they will even allow you to borrow 100% of the purchase price and 100% of the rehab, so long as it fits under that 70% that they're willing to lend you, okay? Now, again, these terms can all be negotiated between you and the lender, okay? So shop around to a lot of different lenders, see who offers the best terms, the best services, and see how hard it is to get the loan, because the qualifications to get these loans are all over the place, okay? Generally, what you want to do is you want to start off by having a very good deal. The better the deal, the less money out of your pocket it's usually going to be, okay? And then speaking of money out of your pocket, there's going to be fees associated with this too, okay? And they can range anywhere from 0 all the way up to 5, 6 points, okay? And a point is a percentage of the loan, okay? Now, these usually have higher points than regular conventional loans because, again, it's going to be more expensive to you, because the loan is going to be more riskier to the lender, okay? So why would anybody want to do these types of loans, right? Or why would an investor want to get this type of a loan? Well, because again, it's going to be hard for them to go to a bank to get this type of loan. So that's where these hard money lenders come in and fill that gap, is because there's a lot of need for this type of financing out there from real estate investors that they can't get from large institutions or banks, okay? Now, the good thing about these is if you do it correctly, you can actually do no money out of pocket with these, okay? And now what I mean by that is that, let's just say if you bought a property using a hard money loan, and let's just say you got 70% of the ARV, okay? So again, easy math. If ARV is $100,000 and you got $70,000 as your loan, that include the purchase price and the rehab, and then you fix it up, and now the property is ready to be lived in. You rent it out and you refinance it, okay? So you get a new conventional loan to replace your hard money loan. Generally, if you did it correctly and if it was a good deal to begin with, the amount of money that you borrowed from the conventional lender to pay off the hard money lender, hopefully they'll give you a higher loan amount, okay? So let's just say the conventional lender gives you 75%. So you would use the $70,000 to pay off your hard money lender, and you would pocket the other $5,000, okay? And that essentially becomes a zero money out of pocket for you, or what we call infinite return, okay? So a lot of real estate investors like to use these type of loans because that's a possibility to get these type of return, to get infinite returns. Now, not all deals are going to be exactly like that, but that's a possibility, and that's what a lot of investors try to strive for by using hard money loans. Okay. Also, hard money loans are good for newer investors because they don't have all the connections to find financing for their deals. Usually, hard money lenders are willing to work with newer investors because, again, they charge a lot more. So that way they can protect themselves from the risk. Okay. Now, that's not a bad thing. As a real estate investor, you have to understand that you need to stop thinking like a regular homeowner that goes out there and just to get a conventional loan. Okay, you got to start thinking like a real estate investor. Just throw out all those low interest, low down payment loans out of your head. Okay. If you are a real estate investor, you really need to start thinking about hard money loans and how to incorporate them into your toolbox of finance. So when you have a deal that comes across where hard money might be the option, then at least you understand what a hard money loan is, and maybe you're able to use it to actually get the deal and, you know, make that infinite return or whatever return you're trying to hit. Okay. So this was a really quick video about hard money loans, how to get them, how to use them, you know, the terms and all that stuff. If you want to know more about it, go ahead and leave a comment in the section below. If not, I will see you guys next week on the next episode of Real Talk.